I'm on page 212 of the Reference Guide to Regulatory Compliance. I'm within the Lending Limits chapter of subsection 2 about credit. And I was in the middle of talking about how loans to leasing companies actually are not covered under lending limits. And loans to leasing companies would be deemed a loan to a leasee if they are for the purpose of purchasing equipment for lease. The bank evaluates the creditworthiness of the leasee before making a loan, and the loan is without recourse to the leasing company. The bank obtains a security interest in the equipment and may proceed against it in case of default. The leasing company assigns all of its rights to the lease to the bank, and the lease terms are subject to the same limitations that would apply to the bank acting as lessor, and the leasee's lease payments are assigned and paid to the bank. Subsection 2 of lending limits is now moving out of the coverage section and discussing the general and special lending limits. Specifically, the general lending limit applying to loans made to a national bank or savings association to one borrower may not exceed 15% of the bank's capital and surplus. The bank may lend an additional 10% of capital and surplus to a borrower if the amount over the 15% limit is secured by readily marketable collateral with current market value of at least 100% of the loan amount that exceeds the 15% limit. Readily marketable collateral includes financial instruments and bullion that are saleable under ordinary circumstances with reasonable promptness at a fair market value based on quotations of actual transactions. So again, this is about 15% of the bank's capital and surplus. An additional 10 if it's secured by saleable property. At a reasonable fair market value. The special lending limits, loans secured by bills of lading or warehouse receipts. The bank may lend an additional 35% of a bank's capital and surplus, but it must be secured by bills of lading or warehouse receipts representing title to readily marketable staples with a value of at least 115% of the outstanding loan amount. Staples must be non-perishable, but may be refrigerated or frozen. Staples must be insured if it is customary to do so. An exception is good for loans secured by same staples for up to 10 months if non-perishable, and up to 6 months if staples are refrigerated or frozen. The bank must have the ability to gain possession of the staples in case of default. If a warehouse receipt is issued by a borrower, it must be eligible under this lending limit if it is registered with an independent registrar whose consent is required before the staples may be withdrawn from the warehouse. There is another special lending limit being referred to as the discount of installment consumer paper, described as loans to a borrower arising from the discount of installment paper are limited to an additional 10% of the bank's capital and surplus if there is a recourse against the seller of the paper. If there is partial recourse to the seller, the additional limit applies only to the portion of the credit that is fully guaranteed by the seller. If the bank is relying on the maker of the paper and not the seller, the limit applies only to the maker, and the bank must have records supporting its credit analysis of the maker's ability to pay the loan and obtain written certification by the responsible officer that the bank is relying on the maker, not the seller. Consumer paper includes paper related to automobiles, mobile homes, residences, office equipment, household items, tuition fees, insurance premium fees, and other consumer items. Loans secured by livestock also have a special lending limit that can exceed capital and surplus if the first lien is secured by livestock that have a market value of at least 115% of the loan balance in an amount equal to an additional 10% of its capital and surplus. Now, livestock includes dairy and beef cattle, hogs, sheep, goats, horses, mules, poultry, and fish. The bank must maintain records of inspections and valuations for the pledged livestock that are reasonably current, but not more than 12 months old. An assignment of a lien securing a grazing contract may, under certain circumstances, be eligible for borrowing under this limit if the bank records the assignment of the perfected lien amount is at least equal to the loan amount and the value of the livestock is never less than 115% of the loan amount that exceeds the bank's general limit. Loans secured by dairy cattle are another special lending limit. This is for an additional 10% of the capital and surplus of the bank to a borrower arising from the discount of paper given in payment for dairy cattle. The paper must be full recourse to the seller, and the paper must be secured by dairy cattle, and the bank must be able to perfect a security interest in the cattle. Completion of a project is another special lending limit. It's the fifth being discussed here. The bank may lend over the general lending limits if the funds are advanced to complete a project pursuant to a qualifying commitment to lend. The completion of a project pursuant to a qualifying commitment, the completion of funding must be consistent with safe and sound banking practices, and the completion of funding must be for the purpose of enabling a borrower to complete the project for which the commitment was made. The amount of funding cannot exceed the unfunded portion of the bank's qualifying commitment to lend. So, exactly what does that mean? Does that mean that we're talking about a draw on a construction loan, as long as it doesn't exceed the unfunded portion of the bank's qualifying commitment to lend? Or is this talking about completing a project that it had overruns? I'm guessing it's just for construction loans, draws on construction loans. Nevertheless, special lending limit for savings associations here. If a savings association limit is less than $500,000 as calculated by this rule, the savings association may extend credit up to one borrower up to $500,000. Domestic residential housing loan limit. A savings association limit on loans to one borrower for the purpose of developing domestic residential housing units is the lesser of $30 million or 30% of the association's unimpaired capital and unimpaired surplus, provided that the association continues to be in compliance with all capital requirements. The appropriate agency permits the use of the limit, and the loans made under this limit to all borrowers in the aggregate do not exceed 150% of the association's unimpaired capital and unimpaired surplus. Provided also that the loans made under this rule comply with all applicable loan-to-value requirements, and the authority to make loans under this section ceases immediately if the savings association fails to meet those requirements. In addition to general limits, a savings association may invest up to 10% of its unimpaired capital and unimpaired surplus in one issuer of commercial paper or other commercial debt instruments, provided that such securities are investment grade as of the date of issuance. So, what that means is that 15% of the bank's capital and surplus is equivalent to $500,000, which you can lend to one borrower. And then there's this other caveat here for domestic residential housing loan limit. Allowing the lesser of $30 million or 30% of the association's unimpaired capital and unimpaired surplus, provided it meets all those conditions. I guess that kind of adds up. If 15% of the capital in surplus is $500,000, then perhaps 30% of the unimpaired capital and impaired surplus gets you somewhere around 30 million. But that really doesn't add up, you know, just based on my guesstimate here. So I'm not sure where we got this from. I'm presuming that perhaps the bank is making only one loan to one commercial purpose. But we'll move on to another section here. Credit exposure from derivatives and securities transactions. Derivative transactions, including non-credit derivatives. This is just, this isn't the general lending limit, and this isn't the special lending limit. And it's not the special lending limit for savings associations. This is a whole nother one regarding the credit exposure from derivatives or securities transactions. First derivative transaction we're going to talk about is non-credit derivatives. But, you know, there's also credit derivatives and securities financing and reverse repurchase agreements and securities borrowing that I have to talk about, and I'm going to try to get that done in a couple of minutes here. For non-credit derivatives, as opposed to credit derivatives, the credit exposure to a counterparty must be measured by using one of the following methods. The National Bank or Savings Association must use the same method to calculate counterparty exposure for all of its derivative and securities transactions. And there's three methods here: the internal model method, the conversion factor matrix method, and the remaining maturity method. And they are actually different under the non-credit derivatives than the methods under the credit derivatives, which is the counterparty exposure and the reference entity exposure method. So going into the non-credit derivative methods of the internal model method, the credit exposure must equal the sum of the current credit exposure plus the potential future credit exposure. The current exposure must be calculated by the mark-to-market value of the derivative contract, and future exposure must be calculated using the model that has been approved by the appropriate federal banking agency. The conversion factor matrix method, the second method under non-credit derivatives, is that the credit exposure calculated using this method will equal and remain fixed at the future credit exposure of the transaction as determined at the execution of the transaction by referencing the table in the lending limit regulation, and is based on the length of the maturity. So this is more or less fixed based on a table, whereas the internal model method is something that considers future exposures, which is a shame that you have to use the same method for all of your derivative and securities transactions that are non-credit derivatives, because there's going to be some that just would work better under the internal model method and some that would work better under the conversion factor matrix method. The other method being the remaining maturity method, where the credit exposure under this method will equal the greater of 0 or the sum of the current mark-to-market value of the transaction added to the product of the notational amount of the transaction, the remaining maturity in years, and a fixed multiplicative factor determined by referencing the table in the lending limit regulation. That may be your closest thing to a blend, is using a table that changes to value the derivative, changes over time to value the non-credit derivative. Oh my god, I have 1 more minute to talk about credit derivative methods, which is the counterparty exposure. A National Bank or Savings Association that uses either the internal model method without entering an effective margining arrangement, or uses the conversion factor matrix method or the remaining maturity method, will calculate the counterparty credit exposure arising from credit derivatives by adding the net notional value of all protection purchased from the counterparty on each referenced entity. The reference entity exposure Method. A national bank or savings association will calculate the exposure to a reference entity by adding a notional value of all protection sold on the reference entity. The bank or savings association may reduce the exposure to the reference entity by amount of eligible credit derivative purchase on the reference entity from the eligible protection provider. Oh.